Something extraordinary just happened in the silver market that has institutional traders scrambling. And if you're not paying attention right now, you're about to miss one of the most significant wealth preservation opportunities we've seen in decades. Silver just broke through a psychological barrier that hasn't been touched in over 40 years. We're talking about price levels that trigger automatic buy programs at central banks, that activate emergency protocols at industrial manufacturers, and that send hedge funds into what traders call panic accumulation mode. Let me show you exactly what's happening, why this is different from every other silver rally you've seen, and what the smart money is doing right now, while retail investors are still sitting on the sidelines, wondering if they should pay attention. The price action we're witnessing isn't just another spike. Silver recently touched all-time highs above $66 per ounce. Think about that for a moment. The previous record was set decades ago during a completely different monetary system. We've now entered uncharted territory, and the implications are staggering. But here's what makes this move so significant. It's not just the price level. It's the velocity. It's the volume. It's the fact that this breakout is happening while gold is simultaneously hitting its own record highs, while the dollar is showing cracks, while central banks are buying precious metals at rates we haven't seen since the aftermath of the global financial crisis. This is what market historians call a regime change. The rules that governed silver for the past 40 years are being rewritten in real time. Let me take you inside what's actually driving this panic button moment. And I'm going to show you data that most analysts aren't talking about because they're too focused on the headlines. First, understand the supply situation. The Silver Institute just released projections showing a deficit of over 215 million ounces. That's the second largest deficit in more than 20 years. Total demand is forecasted to hit 1.2 billion ounces. But here's the critical detail most people miss. This isn't a temporary supply squeeze. This is structural. Silver mines don't just appear overnight. It takes 7 to 10 years to bring a new silver mine from discovery to production. And here's the problem. Exploration budgets were slashed after silver's last major peak. The pipeline is empty. There are no major new silver deposits coming online to fill this gap. Meanwhile, industrial demand is exploding. Solar panel manufacturers alone are consuming silver at unprecedented rates. Every solar panel requires about 20 grams of silver. Global solar installations are projected to double over the next few years. Do the math. That's hundreds of millions of ounces of silver being permanently removed from the market, turned into solar panels that will sit on rooftops for 25 years. Electric vehicles are another massive demand driver. Each EV uses significantly more silver than a traditional car. We're talking about the wiring, the charging infrastructure, the battery management systems. As the world transitions to electric transportation, silver consumption in this sector alone could add another 100 million ounces of annual demand. Then there's 5G infrastructure. Every 5G base station uses substantially more silver than 4G equipment. Countries around the world are racing to build out 5G networks. China, the United States, Europe, all deploying thousands of new base stations, each one consuming silver that will never return to the market. This is what makes silver fundamentally different from gold. Gold gets bought, stored in vaults, and can be resold. It's a monetary metal that circulates. Silver gets consumed. It gets turned into products that are never economically viable to recycle. Once it's in a solar panel or an electronic device, it's gone from the available supply forever. Now layer on top of this the investment demand. Exchange-traded funds backed by physical silver have seen massive inflows. We're talking about billions of dollars flooding into silver ETFs. Each dollar that flows in requires the fund to go into the market and buy actual physical silver bars to back those shares. But here's where it gets really interesting. The COMEX, the major futures exchange where silver is traded, is showing signs of stress. Open interest is at elevated levels while registered inventory, the silver that's actually available for delivery, has been declining. This creates a dangerous situation where paper claims on silver far exceed the physical metal available to deliver. Traders call this a squeeze setup. When too many people hold contracts expecting to take delivery of physical silver, but there isn't enough physical silver in the warehouse to fulfill those contracts, prices can explode higher in a very short period of time. We've seen this movie before. In the early 80s, the Hunt brothers famously tried to corner the silver market. Prices went parabolic, briefly touching $50 per ounce before the exchange changed the rules and the position collapsed. But that was a manipulation. What we're seeing now is organic demand overwhelming available supply. The difference is critical. The Hunt brothers were trying to artificially create scarcity. Today's scarcity is real. It's driven by fundamental industrial consumption that cannot be stopped without shutting down the green energy transition, without halting the 5G build-out, without abandoning the shift to electric vehicles. Governments have committed trillions of dollars to these transitions. They cannot reverse course now, which means the industrial demand for silver is locked in for years to come. Now let's talk about what central banks are doing, because this is where the safety flight aspect becomes crystal clear. Central banks have been net buyers of gold for over a decade now. But recently we've seen something new. Central banks and sovereign wealth funds are starting to accumulate silver as well. Not in the same quantities as gold, but the trend is unmistakable. Why would central banks buy silver? Because they understand what's coming. They see the same supply deficits. They see the same industrial demand. They see the same monetary instability that's driving investors toward hard assets. But there's another factor at play: de-dollarization. Countries around the world are actively working to reduce their dependence on the US dollar for international trade. The BRICS nations, Brazil, Russia, India, China, South Africa, have been discussing the creation of a new currency for trade settlement. While the details remain unclear, one thing is certain: any alternative to the dollar will need to be backed by something tangible. Gold is the obvious choice, but silver, with its dual role as both a monetary metal and an industrial commodity, offers unique advantages. It's more affordable for smaller transactions, it has intrinsic value from industrial demand, and it's scarce enough to serve as a store of value. This is why smart money is positioning in silver right now. They're not waiting for confirmation. They're not waiting for the mainstream media to tell them it's safe to buy. They're accumulating while prices are still, believe it or not, relatively reasonable compared to where they could go. Let me put this in perspective. Silver's all-time high in today's dollars, adjusted for inflation, would be well over $150 per ounce. We're currently trading at a fraction of that level. Even after the recent rally, silver remains historically undervalued relative to gold, relative to inflation, relative to the money supply. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. For years, this ratio was above 80 to 1, sometimes even above 100 to 1. Today, it's in the 70s and falling. Historical averages suggest this ratio should be closer to 50 to 1 or even lower. If silver simply reverts to its historical relationship with gold, we're looking at significantly higher prices from current levels. And that's before accounting for the supply deficit, before accounting for the industrial demand surge, before accounting for the investment flows. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It covers how to get physical precious metals into your retirement account without tax penalties, how to diversify beyond just stocks and bonds, and what the process actually looks like. It's in the description below. Worth checking out if you're thinking about protecting your retirement savings with hard assets. Now, back to what's happening in the market right now and why this panic button level matters so much. When silver breaks through major psychological price points, it triggers algorithmic trading programs. Hedge funds and institutional traders use technical analysis to set entry and exit points. When silver crossed above $60, it activated buy signals across dozens of trading desks. This creates a feedback loop. Rising prices trigger more buying, which pushes prices higher, which triggers more buying. In a market with limited physical supply, this feedback loop can become explosive. We saw a preview of this recently when silver spiked to its all-time high above $66 before pulling back slightly. That pullback? That was profit-taking. Traders who bought at lower levels cashing out. But notice what happened next. The price didn't collapse. It stabilized. It found support. And now it's building energy for the next leg higher. This is classic bull market behavior. Higher highs, higher lows, consolidation periods followed by explosive moves. And we're still in the early stages of this cycle. Let me share a story that illustrates what's happening on the ground level. A colleague of mine who works with industrial manufacturers told me about a conversation he had with a procurement manager at a major electronics company. This manager is responsible for securing silver supplies for their production lines. He said they've gone from ordering silver on a just-in-time basis to building strategic stockpiles. They're buying 6 months of inventory in advance, sometimes more. Why? Because they're terrified of supply disruptions. They've seen the deficit projections, they've seen the price charts, and they know that if they can't secure silver, their production lines shut down. Multiply that story across thousands of companies worldwide, all trying to secure silver supplies ahead of anticipated shortages, and you start to understand the demand pressure building in this market. Now let's talk about the geopolitical dimension, because this is where things get really interesting. China has been accumulating strategic reserves of critical materials for years. Rare earth elements, copper, lithium, and yes, silver. They understand that control over critical materials translates to geopolitical leverage. If you control the supply of materials needed for green energy, for electronics, for military applications, you control the future. This isn't conspiracy theory. This is openly stated Chinese policy. They call it resource security. And silver is absolutely a strategic material. It's used in military applications, in aerospace, in advanced electronics. Any country serious about maintaining technological independence needs to secure silver supplies. This creates another layer of demand that most analysts aren't factoring into their models. Government stockpiling for strategic purposes. This demand is price insensitive. When a government decides it needs to secure strategic reserves, they buy regardless of price. We're also seeing interesting developments in the mining sector. Silver mining companies have been undervalued for years. Their stock prices haven't kept pace with the underlying metal, but that's starting to change. Institutional investors are waking up to the fact that silver miners offer leveraged exposure to rising silver prices. When silver goes up 10%, mining company profits can go up 30 or 40% because their costs are relatively fixed while their revenue is tied to the silver price. Smart money is accumulating positions in quality silver miners, particularly those with low production costs, long mine lives, and exploration upside. These companies are going to be cash flow machines if silver continues higher. But here's what you need to understand about the current moment. We're at an inflection point. The market is deciding right now whether this breakout is real or just another false start. The technical indicators are screaming bullish. We've broken through major resistance levels. We've held above key moving averages. Volume has been strong on up days and weak on down days, which is exactly what you want to see in a healthy uptrend. The fundamental picture is even more compelling. Every data point, from supply deficits to industrial demand to investment flows, points in the same direction. Higher prices ahead. But the real question is, how high can this go? Let me walk you through some scenarios based on historical precedents and current market dynamics. Conservative scenario. Silver reverts to its historical average ratio with gold. Gold is trading above $4,000 per ounce. A 70-to-1 ratio would put silver around $57. A 60-to-1 ratio would put it around $67. We're already testing these levels. Moderate scenario. Silver accounts for the supply deficit and industrial demand surge. Analysts who've modeled this out suggest fair value could be anywhere from $75 to $100 per ounce within the next few years. Aggressive scenario. Silver experiences a genuine supply crisis where industrial users are competing with investors for limited physical metal. In this scenario, prices could spike well above $100, potentially testing the inflation-adjusted all-time high around $150 or higher. Which scenario plays out depends on several factors. How quickly does industrial demand grow? How severe does the supply deficit become? How much investment capital flows into silver? What happens with the dollar and broader monetary policy? But here's what we know for certain. The setup is extraordinary. The risk-reward is heavily skewed to the upside, and the smart money is already positioned. Let me tell you about another conversation that really drove this home for me. I was speaking with a wealth manager who handles portfolios for high-net-worth families. These are people with tens of millions of dollars in assets, old money, conservative investors. He told me that for the first time in his career, these families are asking about precious metals allocation, not as a small hedge, but as a significant portfolio position. They're talking about moving 10, 15, even 20% of their liquid assets into gold and silver. Why? Because they're looking at the same data we're discussing. They're seeing the monetary instability, the supply constraints, the industrial demand, and they're making a calculated decision that precious metals need to be a core holding, not a speculative side bet. This is the definition of smart money. These aren't day traders chasing momentum. These are families that have preserved wealth across generations. They move slowly, deliberately, and only when they see compelling long-term value. The fact that they're moving into precious metals now, in size, tells you everything you need to know about where we are in this cycle. Now, I want to address something important. Some people hear about silver rallying and they think they've missed it. They see the price at $60+ and they remember when it was $20 a few years ago, and they think the opportunity has passed. This is a critical mistake. In bull markets for commodities, especially commodities with supply constraints, the biggest gains often come in the final stages. The move from 20 to 60 might seem impressive, but the move from 60 to 100 or beyond could happen much faster. This is because of the supply-demand dynamics we've discussed. As supply gets tighter, as more buyers compete for limited metal, prices don't move in a straight line. They accelerate. They go parabolic. We saw this in the last major silver bull market. Silver spent years grinding higher from single digits to the 20s. Then, in the final months of the rally, it exploded from 30 to 50 in a matter of weeks. That's the nature of supply-constrained markets. The end game is violent and fast, and all the signs suggest we're entering that phase now. Think about what happens when a major industrial manufacturer realizes they can't secure enough silver for their production needs. They don't negotiate. They don't wait for a better price. They panic buy. They'll pay whatever it takes to keep their factories running. Think about what happens when a sovereign wealth fund decides they need to allocate 1% of their trillion-dollar portfolio to silver. That's $10 billion of buying pressure hitting a market that trades maybe a few billion dollars of physical metal per day. The price impact would be enormous. Think about what happens when retail investors, the millions of people who have never owned an ounce of silver, suddenly decide they need exposure. When silver becomes a mainstream investment thesis, when it's on the cover of financial magazines, when your neighbor is talking about it, that's when the real mania begins. We're not there yet. We're still in the phase where informed investors are positioning ahead of the crowd. This is the opportunity. Let me share one more piece of data that really crystallizes the situation. The U.S. Geological Survey tracks global silver reserves. Their latest estimates show that at current consumption rates, known economically viable silver reserves could be depleted within the next couple of decades. Now, that doesn't mean we'll run out of silver entirely. Higher prices will make previously uneconomic deposits viable. Recycling will increase. Substitution will occur in some applications. But it does mean that silver is genuinely scarce. It's not like iron or aluminum where we have centuries of supply. Silver is a precious metal in the truest sense. And as the world electrifies, as we build out renewable energy infrastructure, as we deploy billions of connected devices, we're going to consume silver faster than we can mine it. This is the fundamental thesis. This is why the panic button has been hit. Because the people who understand these dynamics, the institutional players, the industrial users, the sovereign buyers, they're all trying to secure supply now before the shortage becomes acute. The price action we're seeing is just the beginning of this realization spreading through the market. As more participants wake up to the supply-demand imbalance, as more capital flows into the sector, prices will continue to climb. And here's the thing about safety flight. When investors get scared, when they lose confidence in paper assets, when they see inflation eroding their purchasing power, they don't move slowly, they stampede, they rush into hard assets all at once. We saw this in the aftermath of the financial crisis. We saw it during the pandemic, and we're seeing the early stages of it now. The difference is that this time, the underlying fundamentals are even more compelling. The supply situation is tighter, the industrial demand is stronger, the monetary backdrop is more unstable. This isn't just about making money, though the profit potential is substantial. This is about preserving wealth. This is about having a portion of your assets in something tangible, something that can't be printed, something that has intrinsic value. Silver has been money for thousands of years. It's been used as currency, as a store of value, as a medium of exchange across every civilization. That's not going to change because some central banker decides to print more paper currency. The panic button level we've hit is a wake-up call. It's the market telling you that something fundamental has shifted. The old rules don't apply anymore. The assumptions that governed silver for the past 40 years are being challenged, and the investors who recognize this early, who position themselves ahead of the crowd, who understand that we're in the early stages of a major bull market in precious metals, those are the investors who will preserve and grow their wealth in the years ahead. The question isn't whether silver will go higher. The supply-demand fundamentals make that almost inevitable. The question is whether you'll be positioned before the next leg up or whether you'll be chasing prices after the move has already happened. This is your moment. This is the panic button level that separates those who see what's coming from those who react after the fact. The smart money has already made their decision. Now it's your turn.